And I'll introduce David Friedland, who is Managing Director of Interactive Brokers Far East, but also handles a lot of worldwide interactive brokers issues. And let him introduce the team on their side.
Okay. Well, Don, thanks for having us. As mentioned, I've been with IB since the early days, since 1985, when we were at Timber Hill. So I helped actually a long time ago, got involved with coding and was in the trading desk and some of the algorithms, and I have experience in the back office. And I got went to grad school. When I came back, I got shipped out to Hong Kong for a 2-year stint because it was a burgeoning electronic market making business or electronic trading that was going to happen. And so I came out here to start it up, and my 2-year stint has now turned into 20 plus years. I stopped counting. So here I am. I got involved with some of you have heard of me from Elite Trader. I've been happy trying to post as much as I can. I'm not as active as I was, just because I'm just driving too many hats, right? Juggling too many hats. But I'm happy to answer questions later. But the main topic here, speaker, of course, is Steve Sosnick, who many of you have seen on CNBC, on Bloomberg. Option. He was a market maker for Timber Hill's desk for many years, and I'll be the first one to say he knows a hell of a lot more about options than I do, even though I ran a desk. Be a great speaker, as you all know. And with us also is Eric Cott. He's from institutional sales desk. He can answer some particular sales question and follow up with any of you afterwards with more particular or personal questions you may have. So with that said, let me pass you to Steve. I don't think he needs much more of an introduction, but Steve, if you want to add, go ahead. But I think we all know you.
Yeah, no, the one thing I'll just give is I'll add to the background. I joined it'll be 26 years next month. And just to put a little spin on how long you've been there, you were in Hong Kong when I started, David. So it's been a while. I think we've all kind of stopped counting to a certain extent.
Yeah, try to leave that off. But yeah, 1990, I came out here in 1995. But it's been a great run.
Yeah. So you moved over there. I think I probably was hired to replace you for all I know. And so I joined the firm. We were an options market making firm. We were making the big push into equity options trading. It was basically, we were supplying quotes via the revolutionary technology of handheld computers. And our guys on the floor looked like Sherpas going out there with these, tablets that were, each of them probably weighed 5 or 6 pounds, and they'd go out with multiple ones because they couldn't handle too many quotes. But that was revolutionary. And I was hired because I'd been at bulge bracket firms with equity and option trading experience. And I wasn't sure this was going to last very long as a career. And obviously they got their hooks into me, and here I still am. Now, one of the things that we're going to talk about is over the last few years, basically, when David and I joined, the firm was Timber Hill, and we were an options trading firm, options, futures, stocks, etc. Along the way, we actually purchased a small German-based brokerage firm called Interactive Brokers, a web-based, this wild technology of web-based brokerage. And as the exchanges went more electronic, we were building up our electronic trading capabilities. And one of the things that we kind of realized was as you're building out electronic trading capabilities, there's a lot of fixed costs, but the variable costs aren't that high if you want to add capacity. So we realized it was fairly cheap to add capacity. And the thought was that if we could, get people trading on our platform, on this platform, they would trade with us on the floors, and there it went. And over time, the child overtook the parent, and the name of the firm got changed because Timber Hill was not a name that meant very much to anybody who was not a professional in the business. And so we became Interactive Brokers. And the big change for my life was About 5-6 years ago, I started being allowed to write in Barron's and, and talk to the media, which was not something we did very much as a firm. And got invited to go on Bloomberg TV, and then that led to other gigs in that part. So I started to juggle the trading responsibilities with being sort of the guy who talked on TV or in the media. But then where the big change came was a couple of years ago. We decided that over time the analysts would basically say at every earnings call, when are you going to ditch the prop trading business? And eventually we did. So most of my colleagues actually went to the hedge fund Two Sigma, where they basically assume most of our market making responsibilities. But because I'd changed roles to a certain extent, I stayed behind. So I do handle, I do run whatever trading is left. But we are not the traders we used to be. And this will get into some of the questions that you guys asked. And Don was nice enough to send basically an outline with the questions that he thought were most relevant. And I think without further ado, I'm just going to delve right into them. The first question, for example, involves payment for order flow. I'm sorry if I'm reading off my other screen. IB advertises extensively. It gets better pricing by better routing and not accepting payment for order flow. How much of a real advantage is this? Is routing to Timber Hill arguably a partial exception? So let me answer the last part of the question first. There is no routing to Timber Hill. Timber Hill does not trade options or stocks anymore. We don't.
Well,
so there is no routing. Sorry.
I'm going to interrupt you. There's actually one exception people don't realize. We actually still make markets in Hong Kong and India.
Yes, I was going to get to that you were the exception.
I may have a little bit of an input on that one, but the same old's true. Timber Hill, we don't see Interactive Brokers quotes. If anything, Timber Hill provides quotes and liquidity to Interactive Brokers. But sorry to interrupt, just to make it clear.
No, that's a very crucial point.
It's such a big thing. I've been so involved in this from the early days that we've never seen flow. We've never taken advantage of clients. And it's such a big deal, and it's really important about the ethos of our company. But sorry to interrupt.
No, that's okay, because it really became harder for us. Part of the reason why we don't trade on a proprietary basis anymore was it became almost impossible to deny. The perception was there that all the Interactive Brokers order flow was being routed to Timber Hill, whereas we never did this. And so in many ways one of the ways it's easiest to deny something like that is to hold up our hands and say, we don't do it. It doesn't happen, it doesn't occur. So that's that's basically where we stand on that. You know what, I'm actually going to let some of the stuff go. I'm going to actually ask my colleague Eric, by the way, who some of you may know, because if you went to any of the Options Industry Council's presentations aimed at RIAs, I'm not sure how many of you are RIAs, but if you're an RIA who trades options, you've probably seen Eric, because that was his role before he joined us. So without further ado, Eric, I'm going to ask, because some of the PFOF stuff is best answered. I think you can answer that in terms of because you've been very close with Thomas in terms of what he's been saying about PFOF.
Sure, and I'll first start off by thanking David and Steve for including me. I am very new to IB, less than a year, but as you can all tell from the video, I'm the one that doesn't have the hair. Both of these guys do. So I'm probably, this is the stress level of being in the derivative industry, which I was. I'll just give you the 30,000 foot perspective. I spent about 11 years with the largest equity derivatives clearing firm in the world, the Options Clearing Corporation. I was very fortunate to work with Steve, not only in North America, but in Canada. I knew David's name. I knew folks over at Interactive Brokers. I do believe that it was either Don or was it Tom that brought up Cynthia Tomaine, who I used to work with, because we did a lot of interfacing with IB. And as things changed during COVID in 2020, I live here in Florida. David is in Asia and Steve is up there in the East Coast. So I was fortunate enough to join on the institutional side, and as Steve had mentioned, had quite a lot of interaction. I developed the education and business development and research for what was 6 exchanges, which is, I believe, now 16 on the listed option side. But I wanted to share something, and I appreciate both gentlemen allowing me to do this. There was an article that I actually did send out to a couple of clients. Our chairman, Thomas Peterffy, spoke eloquently, I think it was last month, prior to Robinhood going public, and made a comment that it was healthy to have competition in the industry. But for the two gentlemen that have been at the firm, Stephen and David, for so long, know that Interactive Brokers is always ahead of the curve. I just want to read this from this article. It was, and I'll get it. I'll make sure I get it to you, Don, so you could share it. But there was a petition that went around trying to ban PFOF, and it exceeded somewhere close to 55,000 signatures. But what was really interesting is that Thomas claimed that the SEC won't ban payment for order flow. He stated that in such an eventuality, Citadel would end up buying Robinhood alongside with other brokers. And I quote Thomas. He said, if they were to prohibit payment for order flow, what has to happen is you would have Citadel buying Robinhood and Schwab would buy Virtu, and the two sides would put themselves together into one company. So what's unique about Interactive Brokers is that we rely on what we call pro tier accounts, and with a monthly subscription and a percent per share charge. So Steve, I just wanted to add that to the conversation. I think it's what separates us.
No, I think that was very important for you to, because ultimately, Thomas Peterffy is still the man who calls the vast majority of the shots. And so I think it's very relevant to give his, Eric, since you had his answer to that question, I felt it was best for you to do it. So you know what, so I guess number one and number two, I'm going to answer them together because the next part involves smart routing, which is, which comes from, Ryan. I wonder if smart routing guarantees better fills than PFOF, and if they can provide any evidence from IBK or Lite that demonstrates such. They're charging commissions for IBK or Pro, so is it worth the cost? So let's get into the payment for order flow with a bit more granularity. I think the idea of putting payment for order flow, besides Thomas's comments, it's going to be very tough to ever put that genie back in the bottle. Too many people like the free stuff. Now, the old argument is if you're getting something for free, you are the product. And that's, the product is you. And what the payment for those who pay for the order flow are basically saying that we have arrangements with the brokerage firms, and they basically more or less get a first look at the order flow. They know how much they want to pay for the better order flow for them, which is small customers who trade marketable orders. Those are either market orders or limit orders that hit a bid or lift an offer, and those tend to be the highest payment, and they don't really want to touch the stuff that they consider the smart money, because it's not as lucrative for them. And these guys are all very smart. They're very intelligent algorithms, and there's different tiering in many cases about what kind of order flow they want to get. Robinhood being a particularly lucrative type of order flow because one could argue that they have a very high percentage of novice and aggressive investors who are willing to pay that kind of order flow, to provide the kind of order flow that they want to pay for. So can you guarantee that smart routing offers a better fill than PFOF? No, there's no guarantees in life. But do we feel reasonably confident that by smart routing, we can do a better job? Yes, because think about how the order flow providers make money. in a very tight, in markets where there's very tight spreads, obviously you want to buy on the bid and sell on the offer if you're a market maker. That's, of course, again, that's what they're paying for. And what do? They are then going to probe the marketplace and see if there's a place where they can sell what they just bought on the posted bid in a dark market that's at a slightly higher price, or vice versa. And wouldn't you rather be the one doing that, using an algorithm that does what the payment for order flow people are using, use something analogous to probe the markets on your own and try to get you the better execution, rather than just sort of saying, here you go. In terms of the statistics, the SEC is very clear about publishing the statistics in terms of price improvement and such. I got to admit, I meant to look these up in detail, and I did not. But it is my belief that you get what you pay for. And Eric or David, if you have the statistics handy, which I do not at the moment, but I believe that there is an advantage. We find that a lot of our more, let me put it to you this way. Our heaviest users tend to pay commissions. They tend to be smart order. They tend to, I don't want to mix up terms. They tend to be very intelligent about the markets and very discriminating about their execution quality. And as a result, many of them pay for the executions. And so these are some of the smartest, most intelligent investors. Let me stop using smart. These are some of the most intelligent investors out there, and they obviously are finding a real utility in this. They don't want to pay for things if they don't have to, but yet they do. David or Eric, have you got the statistics at all handy in terms of the price?
I'll leave that to Eric. I know I forget the latest. We do we hire. Now it used to be TAG, but it's IHA Markets now. They do independent audit, and the price improvement is substantial based on what they come back with. But more telling than the statistics is, sure, if you're going to place, if we're all going to place the same bid at the same time, we may all get filled if the market's moving in that direction or not. But it's the fills you miss that are evident. And more importantly is, we have a very active, our statistics in terms of daily average revenue trades are pretty obvious, that we have many active, very active clients. And they, in the States, they have access to the IB Cara Lite. And we've had very little transfer over to Light, actually surprisingly low numbers, which I mentioned in our earnings reports. And people try it, they move back. The thing with smart is it works, especially if you're trading stuff that's less liquid. It moves the orders around, and there's a lot of games. Think about it. You're all traders. If you can game the system in any way, well, that's what you try to do sometimes. Playing in order, you move things around. You can try to bait people into doing certain trades. The high frequency and the algo traders are doing this with highly sophisticated systems, and they're beating you without even knowing it. They're so fast. So on one particular trade, you might not see improvement, but the more active you do, it's your statistics. The more you trade, the numbers will show up and you get better improvement. That's how I see it. Eric, I'm sure, has a lot more on this than I do, given his experience with other firms.
Yeah, I would add to that, David. I would say, look, Fidelity, and it's included in this article as well, because you just alluded to it, is that, what is it saying? That 50% of the orders, this is a report from Fidelity, because it has to be reported under SEC Rule 606, but that I think it was in the first quarter of 2021, the bulk of Fidelity's orders were going to Citadel, and over 50%, for market and marketable limit orders. So, again, and it's all the firms that are out there, apart from IB, it's Schwab, it's now with merging with TD, E-Trade, et cetera. And obviously Robinhood having the most relevance in the press, I think from everybody that's part of this investment group, saw the news that impacted the stock, mainly due to the fact of the relationship that Robinhood has with Citadel.
So coming back around, so, we feel that our smart routing is a means for differentiating. And again, we're talking about very small amount. The differences are small amounts of money, but the more you trade, the more it adds up. And that's really, anything statistical. And I'm sure many of you guys are very astute statistically, law of large numbers. So, if you trade once a month, once a week, which I'm sure you guys do not, fine, let's do the payment for order flow, let it be free, especially if you're not a super active trader. You know what, if I give up a penny here or there, but my holding period is 2 years, what do I feel like I'm carrying? But if I'm actively trading, I want to be the guy. I want to be on the side of the person who's trying to find the inefficiencies and exploit them, rather than handing off my orders to the person who knows how to exploit them. Who's going to handle your order better? And that's what we feel the competitive advantage is. If I could wave a magic wand, do I think payment for order flow is the best system out there? No, I really do not. And in many countries, it's illegal. Most countries, actually, it's illegal. But it's here. I don't think the genie's going back in the bottle. And so, learn to, you guys are in a position to learn when it benefits you and when it does not. So I think that should, kind of answer the payment for order flow questions, which I see as one and two on the list on sent. By the way, if I didn't get this, please let us know, and we'll be glad to go back into it later. More Q&A. But I think that's our talk on this. The next one I see is, can you explain rebates and taking and adding liquidity and how this interacts with the choice of commission schedule? IBKR provides tiered and fixed commission schedules. Who should use tiered when? I'll leave Eric to answer the second part of the question, because he's much more experienced at answering that question than I am, or David can answer it as well. But I think Eric probably gets asked that question on a daily basis. Rebates and taking and adding liquidity. I assume many of you have heard the term maker taker. And let's roll back and say, okay, there's 16 options exchanges. Does the world need 16 options exchanges? I'm going to argue no, especially when there's really only 5 exchange families. So what that means is, on average, each exchange family has 3 different venues. Well, what is the how do you differentiate your venues? Well, one of the things that, as the exchanges started to compete with each other, was they realized we can't all have the same model, because that's kind of silly. So they developed different ways of doing it. One of them, one of the old school ways, you just placed your bid and offer, because there was one major exchange, and you either got hit or you didn't, and you move on. Then as you started to get into competition, you differentiated how you would attract the order flow. So one of the original ways that came up was maker taker. And you would incentivize, you would basically pay the exchange would more or less pay the brokerage firm. You always, when you traded, you always would have, you pay an exchange fee. There's data fees and exchange fees. So, but if you provided liquidity, meaning you put your bid, you put an order on the bid, or you placed it on the offer, you were a liquidity provider. You were providing liquidity to the market, and so you would get a rebate on the liquidity that you provided, on what you placed on a bid or an offer, to provide depth to the market. If you consumed liquidity, meaning you cross the bid or offer to cross the bid or cross the offer to cross the spread to do a trade, you were charged sort of a surcharge on that. So basically, you had this incentivized, they incentivized market making that way. So you would place your bids and offers and hope to get hit, and you'd get a little bit of a rebate if they interacted with your passive liquidity. As things evolved, you have all kinds of different models. So you have maker taker, you have taker maker, which is exactly the opposite of what I just described. You've got again, one of the changes was the price improvement auction, which we were a part of on Box, which basically gave customers the opportunity to expose their orders to, well, the brokers on behalf of the customers expose their orders to price improvement auctions, that would be exposed to the market for a sub-second period, and people can interact with them. And so now you have all sorts of, that idea, like all good financial ideas, gets copied. So there's all sorts of auction mechanisms that are out there. And what will happen is the exchanges will tweak their algorithms and say, okay, if you bring this, if you're the broker who brings this order to this exchange for price improvement, we'll guarantee you 40% of the order if you end up crossing. Everything does have to get exposed, but we guarantee you that you'll get 40% of it, or whatever the prevailing price in the auction, or so then exchange B says, we'll guarantee you 50% of it. And what'll keep happening is the main order flow providers and market making firms will basically try to negotiate stuff out, and it goes around, and it's actually in many ways even worse in the equity arena rather than the options arena, because there's almost an infinite number of venues. But everybody puts on their little tweak. I've sat on the board of three different small stock exchanges, and what we do, we see this all the time. Okay, such and such firm is going to bring us their order, X amount of their order flow. If we tweak the rules to do this, that, and the other thing, and you see all, you tweak the rules, the orders flow in, and then, a few months later, you don't see their business anymore. Why? Because the next exchange offered them a deal that was to their liking, that was like a couple basis points better. So that's what goes on in terms of maker taker, payment for order flow, maker taker and rebates, and the idea of consuming, so there's different ways. If you really game it, the high frequency trading firms know how to do this because they're trading for very small fractions of a cent. And so the maker taker, which is, pips, pieces of a basis point, this is meaningful to them. Again, remember, everything when you do it enough times gets magnified. And so they're very cognizant of that.
Steve, if I can interrupt 1 second.
Of course.
Just add one thing. So in Asia, I've been on a number of exchange committees and panels, and involved obviously in some of the, Timber Hill, we were the largest options trader for quite some time. And I find it hilarious when you say all these maker takers. Initially, it's not the exchanges coming up with these rules. It's the market makers who are going to the exchanges and saying, hey, if you give me this rule, I guarantee, I promise this. And they're all self-serving. They, I'm very, I better not name names here because it's,
Well, that's why you'll notice I didn't mention the 3 small exchanges that I was on the board of, nor did I mention who would come and promise us things.
Yeah. But it's typically the same names and a certain nationality, not American, at least out here, and not Chinese, because I don't want to pick on China. And it's definitely, but they come in with these rules and they say, oh, this is going to be great for the market. It's going to, and they convince certain people at the exchanges who don't have options experience or trading experience. And I used to get a little, perverse pleasure kind of calling them out in these committees, because end of the day, at least what I always took to these panels was, if we can do what's best for the person on the street, they trade more. This actually goes back to something Thomas way back. He got mad at one of our traders who were working with a specialist to widen a quote, and the specialist was ripping people. He ripped someone off, outside of put call parity, and he made him bust a trade that was very profitable. And the logic was, this guy will never trade again. You just ripped him off. But if you made a normal spread and we make our 5 cents or our 10 cents, whatever it was back then, and we make that same trade 1,000 times over the next 5 years or this year, we make a lot more money and we grow the market. Now you have one person who lost money. He tells everyone around him that the option markets are rigged and they don't grow. So this was back in the early 90s. And the same thing, it's still going on today. The market makers, HFTs, are looking to just get an edge. And the exchanges became complicit in this once they all went public. Because they, instead of going from nonprofit, they're public institutions. And now they know what's best, but at the end of the line, they need to fill their bottom line. They need to feed their staff. They need to feed the governments around them, their exchange holders. And I wouldn't say the system is rigged, because there are firms out there fighting for what's right. The regulators tend to do a decent job. I'll leave it at that. And it's just an interesting way. You're always going to get this push and shove. So when a new rule comes out, just try to think of who's really pushing this rule and why.
You know, David, I would add something to it. You just made me think when I had started in 09 over at the OCC, which actually is not publicly traded. I think they've talked about it before. The Options Clearing Corporation trying to maybe look at DTCC at the time and trying to their shareholders or the board wanted them to go public. But I think a lot of people on this call might remember when they announced the mini option contracts, which, you know, sometimes things, right, Steve? Sometimes things are positive like leaps. Other times when they come out with a product, David, it doesn't always fly very well. And that came from a lot of constituencies, as David alluded to, that were coming to the exchanges and saying, look, we need to make this available. It's going to be a home run. We've got Amazon. We have, Google, all these high flying stocks. What we're going to do is we're going to literally revamp the listed derivative market, and we're going to make available. And what happened was, like with Timber Hill and others, the market makers said, we can't make the kind of money we can with a 10 lot versus 100. You got one contract with 100 shares. Now you're doing the same thing with 10 shares, and the whole thing just ended up dissolving. So, and I see Britta, thank you. Now these minis would actually, you know what, Britta, you should probably send a message. I'm no longer there to the OCC. Maybe they'll bring it back.
Eric, if you could answer the part though about who should use tiered when. I'm gonna,
and I'll have David add to that. Yeah, sure. But I mean, I think that for, it's the predictability, I guess, of the fixed pricing that, if someone isn't really, it's more of the lower volume, sort of trading people that would want to look at the fixed pricing, versus the tier, which doesn't, include, sort of the exchange, the regulatory clearing fees. I think the separation is when you're not trading a lot. I think the fixed tends to make more sense. And David, please, if you wanted to add anything to that.
Yeah, I mean, generally, if you're more active, tier is generally better. And it really depends on the exchange. So in Hong Kong, for example, we do have a fix, which is a bit higher than tiered, but some people will stick with fixed because the exchange charges per execution. So let's say you submit for shares, 100, well, it's important, it's 100,000 shares, and you get filled 1,000 executions on one trade. It's 2 Hong Kong dollars per execution that we have to, that we're charged. So the tiered will pass that on, the fixed eats it. It's just a balancing act. But generally, I would try tiered, look at it, and you should save money overall. It gives a little more flexibility. I personally have gotten 0 commission trades or negative trades, and other times you look, ooh, I paid more than I wanted, but it tends to balance out in your favor.
Okay. I hope that answers the question sufficiently. The next one, all right, buckle in. I know I'm gonna lose some of you. And this is the role of delta, theta, gamma, vega for traders. Long answer, okay. That's good because there is no short answer for this one. Basically, if you go back and you look at the option pricing model, and I'll just use Black-Scholes as sort of the starting point. Essentially, the price of an option is based on various factors. The most obvious one being the price of the underlying share. And the most obvious one to most people is how does the price of that option move relative to the price of the underlying share? That's delta, right? So for 1%, and I don't, you go in the chat. If I'm being too simplistic, let me know. If I start to get into the weeds, let me know. Okay. So delta being the percentage change, for a percentage change in the underlying, this is the percentage change in the option. Now this is how most people think of options. And when people think, are you hedging? Well, you're going to be delta hedging. Yeah, because the stocks tend to move around the most, and I'll get to the other variables. But the stocks tend to move around. So your most obvious exposure is your delta. Now, the problem is delta is not fixed over time or in a strike space. So if delta is the first derivative of an option price to stock, the next derivative is gamma, which is how does that delta change? And let me give you an example. So let's say we have a $50 option that expires this week. We'll do it very short term. All right. So, on Monday, if the stock is trading about 49.5, and I'm using very rough numbers here because there's a lot of other things that go into it, but the delta with the stock at 49.5 of that option that's struck at 50 for the end of the week, it's probably got about a 35 delta because we're a little bit out of the money, and we're not quite there at the money, so the delta is going to be by definition probably below 50. We talk 0 to 100. It's just easier that way. So we're gonna talk in those terms, and we'll say it's probably about 35. Well, let's say the stock then jumps from 49.5 to 50. The delta, I would argue, is now about 50. It changed. The amount you would need to hedge a similar percentage move has changed. So if I was short that call and long stock to hedge the delta, I actually find myself under hedged now, and I would have to buy some extra stock to stay hedged. In the flip side, if I was long the option, I would need to sell. I would want to be. I can sell out some of the stock. Sell some of the stock against it, and buy. You basically be when you're long gamma. Well, the change in delta is gamma, and so when you're long gamma, you're incentivized to buy low, sell high. When you're short gamma, you're incentivized to buy high, sell low. And so again, let's say now the option let's say the stock goes from 49.5 from 50 to 50.5, the delta is about 70. If I'm long, the price of my option would have gone up, and I would need to sell, and I can actually sell out some of the stock that I'm the short again, I'm sorry, I'm getting all in the weeds here. This is so second nature to me. It's actually very hard for me to explain. And so, basically the need to hedge, if I was going to sell that option, I would need to buy more stock. Or if I was going to buy the option, I would need to sell less to hedge. And so that changes. And the other thing that changes it is time. If we do this on the day of expiration at 49.5, the day of expiration, let's say we've got 2 hours left to go, that delta is going to be about almost zero, right? Because, assuming the volatility isn't insane, we're way out of the money. And then the stock goes from 49.5 to 50.5, right on expiration. Well, the delta flips from 0 to 1, which means the gamma has exploded. So the gamma is the second derivative. And so what you see here is, it's a very dynamic system. And this is why hedgers are constantly hedging, and why it's a very dynamic situation, why it's very hard to stay hedged all the time. And one of the things I'm constantly asked about, because a term that entered the vocabulary pretty much during a little before the meme stock era, thanks to SoftBank, I think they were the ones who really got people going, was the idea of the gamma squeeze. And I think, in last autumn, when we really started to see retail participating in the options market and tending to move as a herd, I'll argue a lot of the infatuation that came with options was, I think, very savvy sports bettors figured out that the payoffs in options were fairly similar to those if you're a sports bettor, if you're betting with odds, right? If I'm buying a call option, I have a fixed outlay, and I get a leveraged payout. If I win, if the stock goes from, if I buy those call options that I described and the stock goes from 49.5 to 52, I've done extraordinarily well for myself. And if the stock stays at 49.5, well, I lost my initial premium, I'm done. That's pretty much the same as if you do a money, if you do odds on a sporting event, or I get, or horse racing, whatever it is. I pay, I put down my bet and I get paid back 2 to 1, 4 to 1, 5 to 1. Nobody posts the odds as they do in a pari-mutuel situation or with a bookie, but people realize that this had a similar mentality. And so what was going on as the markets were going up and up and up, people started to realize that, well, the odds were more and more in my favor than they might have otherwise seen. And so I can make these leverage bets and pay them off. And what we saw with SoftBank was they did it to such an extreme that they actually caught the market off guard. And, let's say people say they're catching the market making community off guard. I don't think that's the case. They're also catching all sorts of savvy traders who see them paying what seem to be very high prices. But, if you get enough weight behind something, it'll move on its own. If you get enough people, I've used this expression a lot, enough ants can move a really big log. And I think that's kind of what we started to see. And then when SoftBank got in the game, well, that was an elephant joining all the ants to move the log. And I think you got a lot of traders caught off guard. It didn't work for SoftBank because none of these schemes really work forever. And it bit them. But you started to see this phenomenon where if enough option traders got on one side of the trade, along with stock traders, because options traders are not usually sufficient to move the stock on their own. They do need behind every gamma squeeze is a delta squeeze. You saw this phenomenon in the meme stock days. That became the extreme. Because you just had so many people on one side of the trade, essentially price insensitive, but it outstripped the ability of the market to hedge it. And so you really did see the gamma explode. And options that were way out of the money became in the money. And whoever was short those options had to scramble to cover them. Well, what are they covering that delta with? They're buying stock, and off it goes. Now, if those were the only two variables, delta and its derivative gamma, so gamma is a second derivative, the game would be somewhat easier in a sense, or not, depending on which side of the trade you're on, because you have your other variables. And one thing you have to bear in mind with options is they decay. And the decay is also nonlinear. The further out you are, the option doesn't decay very much. As you get closer to expiration, the decay falls off a cliff. And as a trader, as a hedger, the one statistic that I paid the most attention to as to whether we were making or losing money on a given day when I would look at the P&Ls was gamma minus decay. We tended to trade a long book, which just worked better for the way our model was, which is actually kind of counterintuitive because you've heard many, many times that most option buyers lose money, and it's the case. We knew that a large amount of our options were going to expire worthless, but we figured if we priced the volatility okay, the theta, as it were, we would basically, if we could trade so efficiently, and we made our trading very, very efficient, and we were constantly hedging. Every trade went into this big algorithm to get everything repriced. I used to describe it as we had this big, think of a big like bouncy ball that you'd sit on, and like, you sit in one place and it kind of bulges out somewhere else. And our job was to keep the ball as spherical as possible, knowing that in certain places it would be pushed in or out. And that was how our hedging ran. So it was in multiple dimensions. But going back to gamma versus decay. So why would I ever sell an option? If really all I'm doing is assuming risk, if the buyer knows his out, has a fixed outlay and an unlimited profit potential, why would I ever do the other side of that? Well, there's a reason for it. And again, as I explained, most options end up expiring worthless. And that is, you're playing the decay. And so what you're trying to do, if you're the option, if you're an option hedger, you want to make, you're hoping that the market has the implied volatility of the option too low relative to the historical relative to the volatility that you realize. I wrote an article on this for Barron's a couple of years ago, and it's been quoted a million times, and I'll send Don the link tomorrow. And it was basically it's called Making Sense of the Three Types of Volatility. And essentially you've got your historical volatility, which is looking backwards and saying that over a certain period of time, whether it's 7 days, 20 days, 50 days, and the time frame should be more relevant to the length of the option that you're trading. Over the last 10 days, the stock has averaged 1% daily moves. Another one that I'll send along is the rule of 16, because that's very important too. And when Black and Scholes developed their model, what they used was annualized volatility, which of course is of little value to anybody. What does it mean if I tell you that a stock has a volatility of a 24? Annualized, it's daily. If I annualize all its daily moves, it's 24%. Well, what does that mean if you're trading an option that expires in 2 weeks? It's pointless. So the way you unannualize is you divide by the square root of business days in a year. The square root of business days in a year, conveniently for option traders, is very close to 256, which is 16 squared. So option traders are really good at dividing by 16. So when I say that implied volatility is 24, what that's telling me is that over the period of time that I'm trying to measure, the market is really pricing in a 1.5% daily move, up or down, or sequential 1% or 1.5% moves, et cetera. So what I'm going to do is, if I'm a volatility hedger, or if I'm an active hedger, I would consider selling that option if I think the volatility is, if the market's telling me that they think it's going to be 24, which is 1.5% a day, and I think this thing is going to move 1% a day, well, then I'm incentivized to sell the option. And I'm hoping that it decays faster than it moves. Conversely, if I want to buy the option, I'm going to say this thing is going to average more than 1.5% daily moves. Now, that could also mean you have a 10% move one day and it doesn't move the rest of the time. So, these things there's different ways how you hedge it. But basically, so we would basically try to see where the market was overpricing volatility in one place and sell it, and see where it's underpricing volatility and buy it there, and keep the positions moving around it. And again, if the ones that we were long, we would be incentivized. The reason we were good at trading from the long side, the long volatility, long gamma side, was we were very good hedgers. So we felt that we could hedge and exploit those changes very, very quickly. And so what you're trying to do is basically say that I'm looking back as a starting point markets tend to use the historical volatility. Well, it was at 24. You have the implied volatility, which is usually uses that historical volatility as a starting point, but then it moves along with the market. If there's a lot of demand for options, you'll see the implied volatility go up. That's how option traders raise their price. And this goes back to like the earliest days of trading. And this was a key element in how we traded and basically how everybody trades. Let's say in the old days, we're going to the floor of the New York Stock Exchange or the Buttonwood tree outside of the stock exchange. And how are you in XYZ stock? Well, my market is $10, $11. Okay, I'm going to buy 100 shares from you at $11. So the next guy walks in. Where's your market in XYZ? Well, it's going to be, I'm going to say 10 and a half, 11 and a half, right? Something of that nature, because I'm short 100 shares. I want to buy them back. If I can buy them back from you at 10 and a half, I'm thrilled. And if I want to sell them, if I'm going to be forced to sell them, I certainly don't want to sell them to you at 11 if I just sold them to the other guy at 11. So I'm 10 and a half, 11 and a half. Well, now, I'll take 100 shares. Now, how are you? I'm 11, 12. Same sort of thing. And so this goes on, this goes on and on. So that's what the way that option traders move their prices is they basically move up their implied volatility or down their implied volatility based on where the order flow is going. And so so what you want to be cognizant of is, so you start with the historical volatility, maybe as your starting point. You change, the implied volatility reflects the bids and offers in the marketplace, the comings and goings of customers, and the positions that are accruing into the street. So in a Tesla this week, as the stock was moving upward rapidly, the implied volatility outpaced the move because nobody really wanted to sell the options at whatever the implied prevailing volatility was. They wanted to sell them at a premium of that because people were paying up for them. And so those who sold the options were then kind of hoping that it would decay faster than the stock would change. That's how you get the pricing on the options. That's how you make your money if you sell them, is on the decay, and you're hoping that the decay is faster than the stock moves against you. And so these are the elements that go in. Vega is, when you think about that, that's the change. That's really also from changing your volatility assumption. So they're related. If I'm long a lot of options, and I can raise the price of the options that I'm long, the prevailing volatility in the market goes up, well, then I make money on that. If I'm short the options and the volatility goes up, I lose money about that. And that's something that people were having problems with during some of the market extremes, is they would find that the market makers, the markets would get so crazy. And I'll flip back to sort of the meme stock example, but I'm sure this went on this week in Tesla to a certain extent as well. There had to be some of this, particularly at the end of last week when the stock sort of stopped moving as aggressively. The implied volatilities in there are enormous. And what can happen is you could find yourself where the stock moves in the direction, if you're long a put or, it goes down, but it turns out that it's decaying faster than it moves down. You can still find that you're right, but you're wrong, because you can end up losing money in the decay because you've overpaid for the initial premium. So these are all the dynamics that are out there. And this is the kind of stuff that we think about. And this is why, when you look back, what volatility did I realize over the holding period of the option? Was that higher or lower than my implied volatility? That's really how option traders decide. If you're an active hedger or a volatility trader, that's how you decide whether you made money or not. And so that's why I call it the three types of volatility: historical, implied. Historical is backward looking. Implied is your best guess of where it is over the time period that remains in the option. And realized is when you look back over your holding period and say, did did I price it right? And so that's really where it all comes. That's where it all comes down to. I strongly urge you to. You can see on my backdrop it says Interactive Brokers Traders Insight. I strongly urge you to check out. Well, I write the stuff I write on a daily, and I publish almost daily. Is on Interactive Brokers Traders Insight. That's part of a larger group that we have, larger effort that we have called IBKR Campus, and in there is basically a huge amount of resources that my colleagues have. That I will really say my colleagues. I've participated in it, but there's so many other people making these efforts in terms of options education, market education. The resources there have become enormous, and they're growing daily. And I urge you, that's really a good place. I know one of the efforts that I was engaged in over the last year, about a year and a half ago, was helping really revamp the options curriculum. And I will say that my colleagues really picked up the ball on that one. I kind of gave an outline, and a lot of people got involved. And we now have the stuff up on Coursera as well. I urge you, if you want to get into the Greeks, to understand it that way. I try to approach it, from a practical point of view. You have to understand the theory, but I've basically just been, so tied into the idea of market making and short-term trading and the gamma versus decay aspect of it. That's really that. Again, that was really where we made our money, was on gamma decay. We figured if we could hedge the delta and just stay out of the minefields, because we know we would always step on a certain amount of landmines. It was inevitable. But if we kept churning away, basically making money, making the trading profits from monetizing the gamma faster than the options decayed, or taking the right position when we're short options and being able to trade those effectively, not necessarily buy high, sell low. That's how we made our money, and that's how professionals many times think of how we trade options. Okay, I think I kept it on track there, and again, I'm sure there'll be other questions that I stumbled through. So I hope we got that.
I'm still awake, and I'll add to all that. My little and very simple way to summarize all this. It happened to me twice. Once when I went to grad school, and when I came out to Hong Kong. The last thing, I don't know why it was only me, but when I was walking out the door, literally across the room, there's a shout. This did happen twice. Thomas Peterffy is yelling at the top of his lungs, "Don't sell cheap options." And that's it. Don't get caught short. Don't. Obviously, a lot of people make money looking for decay, taking advantage of that, but that's a great way to blow out. And if you know your Greeks, you keep on top of them. Hopefully, it'll save you.
Short gamma and short stock is a very uncomfortable place to be, especially now that there's the rules about you can't necessarily short more. You can't short aggressively on when stocks are really getting pummeled. You don't want to sell the lottery tickets.
And not to say you can't make money that way, and there are people very successfully doing that. But I think we left, I won't say billions, but we left serious money on the table over the years just by being long ball. When best year we had was I think was a NASDAQ crash.
1999 through 2001. 2000 and 2001, we clobbered it. Those were our best years by far.
It was just by owning cheap options. Made up for the next 10 years of decay.
I'll tell you a little more. First of all, among the more profitable tweaks that I was involved with making the model was Thomas didn't like to sell options below 50 cents. And as the markets changed, I basically got us to relax the rule to let us sell options down to a quarter, which had a very meaningful effect on the bottom line without adding too much risk. And secondly, I remember this conversation, 2007, I parked my car. Where we are is an underground parking, and I get in the elevator and whatever it is. And I usually park like in the sub basement. And so the door opens, Thomas walks in, and I'm thinking, all right, now there's a fine line with small talk. You got to, acknowledge, but he's not a small talk guy. And so, good morning. What's new? And I said, you know what? I just read the most crazy story in the Wall Street Journal. And that was that Bear Stearns has some hedge funds that look like they could be losing up to $20 billion, in excess liability. And we talked it out, we get out of the elevator, we talked. At that point, my desk was very close to his office. So we walked in the same general direction, and he just kind of looks at me and goes, are you telling me that Bear Stearns could be bankrupt? And I said, I guess I am, yes. And he basically said, and I was in charge of market making for banks and financials and what ended up being the epicenter of the global financial crisis stuff. And he basically said, I don't want you short cheap options in a bank for the next forever. I don't want to hear about it. And we did pretty well in those times because of that ethos. Again, and because we could, because the markets widen, another little rule is, David, I don't know if you would want to put this up, but it was there when I started. There was a sign on the desk, and it was basically what to do in case of emergency: widen markets, shrink sizes, raise volatilities. And that's really what you see going on writ large. And that's why you see implied volatilities go up. That's why you see spreads go up. That's why you see size, markets get more disjointed, is because that's really your way of protecting yourself if you're a market maker.
Yeah, and I'll add one thing to that, just because this is important. The Greeks are important, they're fundamental, but you have to keep on top of the news and what's out there. So one more thing on Bear Stearns. I didn't realize that was you, Steve. You learn something new every day. But an offshoot of that is that in Hong Kong there are warrant issuers, and we stopped trading. We reduced any positions we had, and we stopped issuing or offering warrants in Bear Stearns and Lehman as well. I forget why Lehman, but we had it was just, okay, there's rumors out there, things can happen, it doesn't look good, and we reduced our positions. So we took short-term pain, and there are many times we were wrong on this, and we lost opportunity cost to make money. But the times that we were right on things like this, we've saved millions of dollars. So when you're managing your own portfolio, read the news, and if it you know what they say, if it smells, well, yeah, you know the phrase.
Yeah.
And so use your BS detector. If something doesn't look right, there's no free lunch out there. People tend to know what they're doing. We all know this, but sometimes you have to have a kick in the butt to say, hey, how much am I willing to lose? It's more important than how much to make.
We would tend to get very nervous if there was a trade that was too profitable. But particularly if it was something that involved forward delta, because it almost always meant that we had the dividend in the wrong place. We were off it, if a conversion or reversal. So your BS detector is really, this is where you have to know the Greeks, but not live by them, because ultimately you have to know how they come into play. You have to know how they work if you're going to be trading options at a high level. But ultimately, you still have to have your nose doing most of the work, or your gut, or whatever it is. So, if we're going to go to the next one, how do market on open and market on close orders actually work? Are they sent through to IB or the exchange with special instructions, or does TWS simply execute market orders at specific times? For example, do the market makers / specialists that arrange the opening quotes see the MOO orders? Are there any disadvantages to these types of orders, assuming you specifically want the opening or closing price, i.e. your trading system is predicated on it? Well, there's a lot to unpack. I'm going to assume you're talking about stock orders here. In stock orders, that's a specific designation, market on open, market on close. And the exchanges handle them as such. They are a market order that is only valid on the opening print, or a market order that is only valid on the closing print. And these are very important types of orders because, remember, index options tend to close on Friday mornings, not on Friday afternoons, as stocks and ETFs do. And so that's the way that they need to be hedged market on open by customers, by active hedgers. And for market on close, besides expirations, that's how S&P and NDX and all your indexers handle rebalancing, because it's always as of the close of that business day. So how do you guarantee the close? You put in a market on close order. There's a lot more nuance to what I'm saying, but bottom line to how they do it. But the bottom line is, if a stock is going into an index, everybody knows that the index funds are going to have to buy those stocks. And so in the days prior, people are going to be trading, hoping to sort of surf that wave. But those orders that go in market on close are very specifically marked market on close. We basically pass them down to the exchange with that designation because that's a very specific method of order handling. Does TWS simply execute market orders at specific times? I mean, if you designate, we have algorithms where you could send a market order at very specific times. I know very specifically we have an accumulate distribute algorithm where I could basically fire off 100 shares on a market order every 7 minutes or something of that nature. But if the order is sent to us with a very specific market on open, market on close, we have to pass it on to the exchange that way. Otherwise, we're not doing our duty to the customers. Now, there's also limitations, though. You have to have them. I forget what the times. It used to be 9 a.m. for the market on opens, and I think it was 3:40 for the market on closes. There are very specific times your orders have to be in, and so that if you send a market on open order at 9:28, there's no guarantee it gets filled. So there's specific time frames to them. I think I gave you the right ones, but don't trust me on that. Look them up for yourself if that's a key facet of your business. But I think that should answer the questions. Are there disadvantages to the type of orders? Yeah, I wouldn't do them unless you specifically need to, because there's plenty of examples of very discontinuous opens or closes because of market on open, market on close orders. So there are specific strategies that require you to do that, and so sure, you should do it that way because that eliminates tracking error. If you don't need to do it that way, I'm not a big fan of just blindly throwing market orders in, especially if they're the type of market orders that have to be sent well before they become marketable. So I hope that answers that question. Now, these are going to be more from my colleagues, the next few, and I will try to get through these because I don't think these are as long. They're a bit more specific. Ryan asks, I'm curious what the best way is to calculate profit in an options campaign using TWS, and if the option analysis performance profile screen can take past trades into consideration. I will go into this one because I use the option analytics all the time. I don't know if we could use them backdated. Like, I don't know that we have the facility to look back at how a strategy performed using the option analytics pages. But I will tell you they're powerful because essentially they grew out of what we used on the desk. These are all outgrowths of how we traded. And, what did we find meaningful in terms of our, the option analytics that we wanted. And now over time, we've been listening to our customers for all these years. And so the suite of options analytics is very powerful. Anything you guys want to add about that?
Yeah, I was trying, David, go ahead. I was just trying to find something that I want to go ahead.
I'd say if you're really into detail, the Risk Navigator is actually quite powerful and strong. It takes I think we have some videos and webinars on that. If you want to dig into really analyzing a portfolio and the risk metrics, think it's plus minus 30%. I'd give that a shot and take a look at that. But
Yeah, I mean,
I'm not an active options trader anymore, so I'll have to defer to you.
You can look up,
Eric.
you can look up skew, and I've written commentary about this. You know, one of the most well-read columns that I write is what is the options market telling us about XYZ earnings, and I use some of our options analytics tools, whether it's term volatility, you know, the volatility, which effectively is like when you think of the VIX curve, or the skews, or the skews, or we have something called probability lab, which is basically gives you the option. You basically, we back out the probabilities from the options, what the market's telling you, and you could say, all right, you know, this is great. The stock's trading at 90, and we plot the skew, and you could say, all right, well, you know, I think it's going to 85. I think the highest probability is it goes to 85, and it'll offer strategies based on that. So I hope that answers that one. The next one, I'm sorry.
Steve, Mark is asking a question as far as, I don't want to get into the differentiation between TDA, which is going to become part of Schwab, and IB, but David alluded to this, and I think our probability lab. I think one of the unique things over, and Mark, and I could send you the link to it as well as the video, you know, our right rollover tool, I think it's a unique feature of IB's platform. For folks that are, doing covered calls. I mean, there's a host of analytics, and look, I'm not going to downplay having worked with TD before, but I think from an option standpoint, the strategy builder, I just think there's a lot of technology, options, no pun intended, under the IB TWS platform that are far superior to what you're going to find on TD, especially for folks that are really more analytical and more trading.
Okay, I see, Mark, you're throwing in some of these questions. You know what? Don gave me a bunch of questions, and actually, because literally the next question was, is TWS lacking in usability compared to Think or Swim? And the next really get into these is how do we is stuff about this, and I will say, while we certainly want to be able to tell everybody why you should be using IB, and of course I think you all should, we didn't want to make this an explicit sales call. So I do want to do a lot of the compare and contrast, but we didn't bring Eric here to sell the platform. We brought Eric here to keep the knowledge base up. And so I want to keep us away from sort of overtly doing too much selling. That said, next one is it lacking in usability compared to Think or Swim? I'm going to have to defer to my colleagues because I've never used Think or Swim. I don't know. Do we?
I hear I haven't used them either, but I know from what I read and others say, yeah, they've got a great option platform. I know we have a little bit more of a learning curve, but I think people, spend more time buying a refrigerator than they do looking at their option platform where they make more money. Just spend a little time playing with the tools, but where I think we excel. And I've been part of this for such a long time, and I have written some code way back. I know what we put into, and I also work directly with the programmers. I know what we put into our routing. And for options, a smart router is really, in my opinion, it's makes a huge difference. It's the external reports show it that way, and also internal figures show how we go and we route orders from one exchange to another. We work the orders, we don't sell the order flow, and it does make a big difference, especially if you're doing market orders. Plus knowing all the games the market makers play. But I always say go side by side, try them out. And one other thing is, if you don't like our front end for whatever reason, there's so many third-party platforms out there. It's an open API. Find one that I'm sure there's one that you like. And Eric, I think you have something to add.
Yeah, David, this might be a selfless commercial for Thomas speaking about this, and our announcement, which is probably going on 6 weeks right now about crypto. And I think someone did ask Don about that. That's fairly unique, being able to trade digital currency under one universal platform. I know that our chairman has talked about it. Again, this isn't a opportunity here to try to sell the IB platform, but if you're any of you that are RIAs or you're individual investors and you're looking at crypto, please let us know. I just think it's a very unique opportunity to be able to do that, with other, assets, whether it's equities, fixed income, ETFs, et cetera, that are in your account, allowing you to leverage and then go and purchase crypto. So I want to throw that in as well.
One thing I will say, because I'll skip ahead to that question, which is I'd like more insight into the plans to extend crypto trading. They only offer 4 coins right now through Paxos, very limited. I don't want to speak out of school or speak too much for Thomas, but one of the things David alluded to is there've been a lot of times where that we can point to where we left money on the table and opportunity costs to avoid risk. I'm going to say, and remember what we just tell you are probably our 3 best years were when things blew up. And so we've seen this movie before. And I think it's the kind of thing that we want to be sure that we are, we'd rather be too cautious than too aggressive, I think is basically the theory.
Steve, I'll add to the crypto though. There's more crypto that's in the works to be added.
Yes.
We have to work with Paxos to get things on their system and with compatibility with us. So that's in the works. It should come out soon. We actually, last night, we added crypto for people who, it's not apropos here, but people living in the Caymans, Taiwan.
2 other places. I think Mexico. Yeah, I thought Mexico, maybe
Yeah.
I'm wrong. Yeah.
So we're going country by country because every country has their own rules. But one thing about the crypto is that we don't want to be custodian. And again, it's talking about, we're leaving something on the table, but end of the day, we're about protecting ourselves and the clients. If a wallet gets stolen, it can bankrupt a company. So if you have an account if you trade crypto with us, you're actually accounted with Paxos. Overseas, Hong Kong, we're working on adding crypto as well. We have to work through the regulations, but it's a little more complicated. But at the end of the day, we're either going to form a separate entity or do everything external because we don't want the client base and our cash at risk in case something gets stolen. So there'll always be a little bit disconnect. So you have an account at Paxos, your money and your cryptos at Paxos, but you're trading via IB's interface, and we're the cash facilitator. Put it, I guess, one way to put it.
And David, I just will add to that. I was at a conference 2 weeks ago in Miami with our colleague Judith. It was a private wealth hedge fund family office Latin American sponsored conference, and one of the interesting thing was we were speaking to a head of a very large publicly traded bank in the Midwest, and IB is not approved right there, but you have a lot of the employees there that are going through Coinbase where they actually have lost money or had, hacking that went on. So there's a lot of, concern over this. And I think that, to David and Steve and the whole management team at IB, I think they diligently looked at this and didn't, make an announcement too soon, where maybe a couple other firms did that. The other thing I just would add to the comparisons of other firms that are out there, I think one of the great advantages of IB, not a selfless commercial, is our mobile app in terms of being able to exercise options and do a lot of the analytics that Steve talked about on a mobile app, whether it's a tablet or your phone.
So what I think I'm going to do, because I see I have a clock in the background and I want to make sure we get to as much as we can. I'm going to kind of turn this into a lightning round and throw some of the stuff out with the help of my colleagues. SPX option surcharge of about 50 cents per leg. It appears some brokers, including Schwab, may not be charging this fee explicitly. Can you comment? I really can't comment about what Schwab does or doesn't do because I don't know what Schwab does or doesn't do. So I'm going to leave that one. One that just popped in, does the mobile app have an analyzed graph for multi-leg options? I actually don't do it. I actually use the platform I don't use it on the online version. I believe it does, but not as powerful.
Robust, I don't think. Yeah.
Well, I don't know the answer to that one actually, because I don't use the mobile app because I'm tied to my desk all day.
Mark, I'll make sure to follow up on that.
Are IBKR margins, especially on futures, competitive? Does IBKR change margins too often? Is IBKR liquidation policy very aggressive and unpredictable? There's a lot in there, but so let me go quickly. Are they are margins, especially on futures, competitive? Yes. That's one of the things we pride ourselves in is very low margin rates.
Steve, one thing, we do charge higher margin in certain products based on risk. So currencies is one, and we do review them, but it's all risk based. So there might be other firms charging even $500 a day margins. If that's what you need, go with that firm. We're not going to go down to those levels just because of risk. We have to protect ourselves and our clients.
That was where I was going to go next. Was yes, we change margins too often? Well, I guess it depends on your perspective. We change margins dynamic. We change individual margin. We don't change our margin rates very often. The borrowing rate. We do change the individual margins actively because risks do change. So one person's too often is another person's not enough. But do understand that we're able to offer very low margin rates in general, but lend money very cheaply to our customers because we're very diligent about managing the risk. And so is the policy very aggressive and unpredictable? Aggressive for one, yes, it is fairly aggressive. And I think we're unapologetic about that, is we don't make margin calls, we liquidate. And that's in the agreement. That's part of the, one of the reasons we charge much lower margin interest is that we are fairly aggressive. We don't wait around for someone to try to come back to us with excess margin. If it's not there, we're going to start to liquidate until we're back in line, because unpredictable, that I would argue is not the case. It may seem unpredictable, but the algorithm is pretty straightforward. If there's not enough equity in the account, we will start to liquidate. And again, that's something that we've done aggressively for a while. And for the most part, our customers benefit from this because it allows us to offer the vast majority of customers very, very, very inexpensive margin borrowing.
And Steve, I think it's also the best execution. I mean, that's where we lead with is clearly, putting the client on the same side of the table. I mean, everything is very, very transparent. The lowest commissions, the margin. I mean, it's the financing that we offer. I mean, all of those are distinct advantages. And look, for David and Steve being there as long as they have, I mean, we pride ourselves on a do-it-yourself. But one of the things that, maybe this isn't a great analogy, Steve might have heard me say this when we did this NASDAQ webinar a couple months ago, and David, don't tell Thomas I said this, but it's sort of like any of these people in North Carolina that own a Tesla. I don't have one, but when I hear from Tesla is, if you're in your driveway and you want the dashboard to change a certain color or the heat to go on when it drops, you send a message and all the cars around the world will be changed the next day. We are very open to our clientele. And if there are things that we can add to enhance your trading experience and make it that much better, that's where IB is going to do that. And I will say also, I am actively involved like every day in trying to figure out when we do have to liquidate, how to do it as efficiently and with minimal disruption to the customer. So let's move along. Does IBKR lack full transparent access to CME future user design spreads and RFQs? To the best of my knowledge, no. I think we do offer full transparency. I don't know why we wouldn't. But that's one of the things we always pride ourselves on. I don't know of any exchanges where we willfully withhold their algorithms from our customers. So I don't know if that. If you guys have any reason to contradict me, let me know. Can you ask why Interactive Brokers still charges a commission for equity pairs trades combos when other big brokerages do not? I looked into pairs trading and found out about this.
Payment for flow.
Yeah, comes back to PFUF. So if you're absolutely what it is. That's a quick answer. I've been a client of Interactive Brokers for almost 25 years. Thank you, Sam D.
Yeah.
And I'm very pleased with their overall service. Thanks once again. Everything they do is fine and well managed, but the most important chronic problem is their phones do not get picked up. It can take 25 to 35 minutes before they answer the phone. Yeah, I would say if we have an Achilles heel, that's it.
Let me touch that, Steve, because that's a common topic on steering.
Yeah.
For starters, the more active you are, you're going to get better service. That's just a business case. So with your stats will be routed to the calls, and those key accounts and higher accounts are those. We're putting a lot of people on those desks, and the call times measure have dropped drastically. But the long call times, that's something we're actively trying to address in a number of ways. And it's tough because unfortunately we're in an environment where we're growing fast and you just can't hire. I think it's the numbers like we'd like to get one CS rep for every 1,000 or 2,000 clients. We just can't hire fast enough. And when you hire fast enough, it's a tough job because you guys expect, our clients expect our staff to know about futures, options, traders, global markets, CFDs, currencies, options. It just goes on, and it's impossible to hire people with that skill set. Even myself, I'll constantly look up on the internet, or I'll work with colleagues to provide answers when questioned. But what we're doing is we're putting big effort on the website. There's some AI behind the scenes that's being worked on to provide answers. And hopefully we're going to start some internal forums where clients can help each other. And we have staff monitoring certain chat rooms within the company to assist and provide answers. So there's a number of things going on, and hopefully the reality is 90% of the questions can be answered online via our website material. The other 10% we need to do better, and it's a big focus. It's a challenge, but there's been some progress, believe it or not.
Thank you for that. Is there a way that when you open the option trade change screen to always have strategy builder automatically turned on by default? Sometimes I forget, and when I start to build a butterfly or spread, I click one of the strikes and I'm taken to the main window to buy sell because I forgot to turn on strategy builder. I want that always on by default. Great question. That, okay, this is what David was saying. It's impossible for everybody to know every nuance. Let me just say, I'll look into it, and if it's not a feature, I'll suggest it that we can keep it on by default or not. I don't know. There's just too many variables in there for me to know them all. Unless you guys want to know the answer to that one, but I think that's a fairly esoteric one. I'm going to move along. More crypto trade. I think we actually got through them. Wow.
I know Don's at one. I just want to circle back to one because someone's saying, again, they did ask the question, why IB over TD? And I don't obviously payment for flow was one big thing, but you're all American, I'm American, I'm out here a long time, and the world has become more global. And it's, the early days when I went back to the States, people would, ask if I speak Japanese. I couldn't get information on the Hang Seng index. Of course, that's all readily available. But one thing we do really well is we have international access on one platform, and the currency spreads are amazing. I personally trade a little more currencies just because where I am, and I love rubbing it in the bank's face when they ask me why I didn't convert with them. But there's opportunity out there, and I would encourage you to look at some of these markets that overlap. Hong Kong option markets is actually quite liquid. Stock option markets, people don't necessarily think so, but if you do RFQ and you look at the actual prices, they're very, you can scalp quite readily. But one of my favorite trades I did, the market, I woke up one day, I know at evening, I came home from work and I was watching, I turned on CNBC and I saw the market was down. I think that was crashing at 2,000 points, but the ticker on the CNBC page said you're only down 700 or 500. So clearly the market was rallying. I ran inside, I turned on my workstation, just buying stocks. I said, this is coming back. It's a big crash. And I was looking at one stock in Switzerland for a while that I never pulled the trigger. And it just happened to be on my screen. And I saw that it was down 10%. I pulled the trigger. I did a currency hedge right against it right away. And within 2 days, I was up 30-40% on this one stock. But the point is, it was just a Swiss stock that I never would have looked at. And I just like that because it's actually my first stock trade I ever did in Switzerland. So it's kind of cool. And but I don't think you should limit yourself just on what's available in America, because the American market's so tight, so liquid, so competitive. You might find it tough to get an edge depending on how you trade. But the overseas markets tend to be a little more wide, a little more opportunity. You have to be more patient at times, but there's a lot of potential out there. So that's just one thing I suggest you guys consider looking at.
And by the way, David did refer to currencies. Remember how I said we don't internalize stocks or options? One thing we do internalize still are currency trades under $1 million, basically. And the reason for that is banks don't want it. Banks don't want.
It's actually 25. It's 25,000.
Sorry, 20, yeah. We internalize almost all the smaller currency trades. We do still run a currency book. And the reason for that is the banks don't want to deal with us for small, they don't want every small trade coming through. So we do internalize those. And what we do, it's basically, there is no concept of MBBO, but we're, you're getting tighter spreads than you would with the bank when you deal with us. So
what we actually do on that is that clients can trade against each other. It's a back-to-back transaction against IB as the middleman. But if you have a smaller quote, if it's inside the bid, we have 15, 16 banks and liquidity providers making markets, including our clients. And we'll take the price. If it's inside the MBBO and it doesn't cross, another client comes in, you'll get the trade. There's no spread, nothing on top of that.
Yeah.
If you want a market order get filled right away, what we basically do is take 1 or 2 pips outside the spread. We buy it until our size increase is greater than, the marketable order will flip out of it. We'll try to balance the book. But then, we also have global currency risk with all our different sectors and regions. So we're actually providing some liquidity to hedge our own, or won't call it liquidity. We're part of the order book in terms of we'll do some trades based upon our global portfolio and our risk, because we're looking at that real time.
So with that, I think we actually managed to get in only 5 minutes over budget here. Because I think we were from 7:30 to 7:30 to 9, and I see it's 9:05. So I'm just going to read Murray. Thank you, Murray. Murray's comment about being about 12 years. Thank you. I appreciate that. And I believe my colleagues do. And unless there are any further questions, or Don, if there's anything else you'd like us to cover, I think we managed to kind of get everything in the time allotted to us.
Yeah, and I don't want to take too much of your time. We've already done that, I guess. But, it's certainly a major factor we want to take into account. And also, you're very gracious at answering the questions. And I certainly would add that I felt it was my duty to pass the questions on unchanged, and that they don't represent my views at all. As a matter of fact, Interactive Brokers is a magnificent firm, in my opinion. Thank you very much, David, for arranging this. Thank you very much, Steve. I loved the explanations. It gave me a bunch of trade ideas while I was listening to some of the explanation regarding the creeks. We better, and Eric too. Thank you very much for adding your take close to the action. We better honor our indications that we gave to you all and to our users. Unless anybody has anything urgent they want to add.
If I could add one thing, part of the reason I still do what I do, and I'm sure Steve's the same, and hopefully Eric, as he grows with us over the years, I do because I enjoy the criticism because it makes us better. I enjoy obviously the feedback and the comments. That's also nice too. Every now and then we need a pat on the back. But with that said, I'm not sure how your group works, but Don, I'm happy if you're the people, members of that are listening, if they have further suggestions or things they don't like about what we do that you think we can change, I'm happy reviewing them, working with Eric, Steve, and if and when appropriate, pass them along, especially if there's bugs that we think we can fix. We proactively try to add and improve our product. And the best way to do it is get feedback from those who use it. So,
Magnificent. Then if anyone wants to post them in a thread, we will start on the forum or just post them anywhere, because I know people can never figure out our site. And we'll be glad to forward. And I know that David has an engine for handling this kind of thing in his brain. So because he handles huge numbers of them in other forums, so I don't feel too guilty about sending them to David versus other people. And David, I'm sure, would forward them on. And there were some other connection possibilities too. Anybody else got anything urgent to add? If not, thank you very much again for all of your time, and we'll call it a day. Good night. Thank you.
Thank you so much
Good
for
night.
having
Thank
me.
you. Thank you.
Thank you.
All right, take care, everybody.